Welcome to Banking 101, a first principle jargon-free course on banking. In the previous lessons, we covered consumer and wholesale banking products, which comprise nearly 80% of global banking revenues. We will now turn to asset management and investment banking products that form the remaining 20%. We have previously referred to these products as capital markets products as they facilitate capital markets transactions. To understand these products, we need a foundational understanding of what capital markets are and how financial assets trade in capital markets. We learnt what capital markets are in lessons 3 and 4. In this lesson, we will learn about the trade life cycle. We will split our learning into the two stages by which ownership of securities is transferred from buyer and seller, namely trade execution and post-trade. We will then learn about how ownership of securities is recorded in the first place. Finally, we will cover the entities involved in the trade life cycle. So let us get started. A diversity of financial assets trade in capital markets. The specifics of the trade life cycle change across asset types and across geographies. In this lesson, we will anchor on U.S. equities. However, the concepts are applicable universally. Let us walk through a simplified equity trade. Step 1, you initiate buy order for 500 shares of XYZ Corporation. Step 2, your broker receives your order. Your broker is electronically connected to multiple stock exchanges. The exchange maintains a real-time listing of all unfulfilled buy and sell orders, called the order book. In this example, the first row shows that there are sell orders for 1,000 shares at an ask price of 123.01. The list goes on with quantities listed against the ask prices of sellers and bid prices of buyers. In our example, since the highest bid is lower than the lowest ask price, these orders are unfulfilled. The order book changes every second as orders flow into the exchange. The broker submits your order of 500 shares to the exchange. In case a stock is listed on multiple exchanges, the broker looks up the order books of the stock across all exchanges. Assume when submitting your trade request online, you specified that you are not willing to pay more than 123.400 shares are bought at 122.85 and 100 stocks are bought at 122.91. The trade is electronically executed using a matching algorithm. If the broker had submitted a bid below the lowest ask price, the order would simply get added to the order book as an unfulfilled order. At the point a match is found, it drops off the order book. In the context of capital markets, we often use the term broker-dealer. A broker is someone who merely facilitates a transaction for her client while a dealer actually takes possession of the asset on her books and trades on her own behalf. Compare real estate brokers with antique dealers. In capital markets, a firm that is merely executing trades on behalf of its clients is a broker. An example of a dealer is a market maker who buys securities from a client to fulfill a buy order and later sells it to another client to fulfill a sell order. There are several variations of the trade execution process that we just reviewed. Next, we will take a quick look at 3 of them. The takeaway from these variations is that while there are many ways trading occur, the end result is an executed trade. Not all financial assets are traded over an exchange. For example, bonds, unlisted stocks and many derivatives are traded over the counter or OTC. To understand OTC, think of how real estate is bought and sold. You negotiate price with the seller via your broker. We will illustrate the OTC process with an example. A buyer orders her broker-dealer to buy bonds of a company. Meanwhile, a seller places a sell order for the same company to her broker-dealer. Instead of routing the orders to an exchange, the two dealers start making calls to their peers. Eventually, the buyer's dealer and the seller's dealer match. Unlike exchange-traded securities, where a central intermediary matches buyers and sellers, in OTC, the dealers compete to find a counterparty for their client. The seller sells the bond to her dealer, the seller's dealer then sells to the buyer's dealer and finally the buyer's dealer sells to the buyer. The investors don't have visibility to the prices and the dealers can add their markup. There are thus 2 markets here, one between dealers, and one between dealers and their clients. The clients could be individuals or institutional investors. When distinguishing between OTC and exchange trading, we can think of 2 dimensions of a trading protocol. One dimension is the price discovery mechanism. In request for quote, the buyer seeks quotes from many sellers and price is set when the buyer accepts an offer. In a matching rule-based system, buyers and sellers are matched based on some demand-supply optimization rule. The second dimension is whether the mode of interaction is bilateral or platform-based. In bilateral mode, buyer and seller interact by voice or some form of text messaging. In platform mode, all interactions are on a multilateral electronic platform. An example of quadrant 1 is if we called used car dealers to get a quote on a car. Booking accommodation in Airbnb would fit in quadrant 2. A traditional auction where the seller quotes a starting price and buyers make counteroffers fit into quadrant 3. The auction house administers the rules by which the auction winner is decided. The price of a ride share during peak times is determined by a demand-supply matching algorithm. In securities trading, voice-based OTC trading and electronic exchanges would be in quadrants 1 and 4 respectively. Between the extremes of voice-based OTC and electronic exchanges, there are digital platforms with varying levels of sophistication. In an inter-dealer platform, the dealers request quotes from each other but their clients cannot access it. Next, there are platforms which investors can access but they can only request quotes from dealers. They may not see prices quoted to other investors in such platforms. Finally, in a full-fledged exchange, prices are visible to both dealers and investors. Here the dealer is acting in broker capacity, merely facilitating transactions. Many of the digital trading platforms fit into quadrant 2 of the matrix that we just covered. An example of a large digital platform in the US is the OTC markets where over 10,000 securities are traded. In the US, it is permitted for stocks quoted on an exchange to be traded off exchange in a digital trading platform. Such trades can occur both during the working hours of an exchange and after hours. In primary markets, the trades usually occur in 2 steps. A consortium of investment banks buys securities at a discounted price from the issuing company. They then sell to investors based at the offer price. Hence the first 2 trades are executed somewhat differently than subsequent trades on the exchange. In algorithmic trading, a computer code executes trades based on pre-programmed rules. For example, a rule could be to buy equities of energy companies if the price of oil increases beyond a threshold. We now turn to the distinction between trade execution and settlement. To draw an analogy, the day your offer on a house was accepted is the trade date. The settlement date is the date of closing. Settlement refers to payment for goods or services delivered. In the current context, the goods delivered are securities. Settlement can occur on the transaction date, say, when paying for coffee at a store. In an e-commerce transaction, the seller may charge our card after goods have shipped. Here, the transaction date and settlement date could be different. In securities, the trade and settlement dates are different. Trade date is the date when the buyer and seller agreed on the trade of a specified quantity at a specified price. The financial risk of holding the security is transferred on this date to the buyer. If the share price crashes from this point, it is the buyer's loss. The trade date is sometimes abbreviated as day T. 2 things happen on the settlement date. First, the ownership of shares transfers from seller to buyer. This is the delivery leg of the trade. Second, cash is transferred from buyer to seller. This is the payment leg of the trade. The settlement date is often referenced as a rolling number of days from the trade date. For instance, people may say that most equities settle on a T+2 basis. This means the settlement date is 2 days after trade date. The processes between trade execution and settlement are referred to as post-trade. There are 3 types of risks in a capital markets transaction. Next, we will review each one. Market risk is the risk that the value of securities may crash after you buy them. There are 2 additional risks that are operational in nature, which we will turn to next. To understand principal risk, think of physical share certificates. What happens if you handed over share certificates and the buyer did not pay? Or vice versa. The risk is same even in a world of digital records. When we buy a house, the record of ownership is often electronically maintained at a government agency. Imagine if we paid for a house and this record was not updated. The third risk is replacement cost risk, which is the cost incurred in replacing the original trade with a trade at a more unfavorable price. Counterparty refers to the 2 sides that are trading. Replacement cost risk is the risk of the counterparty not delivering cash or securities on settlement date. Suppose the closing date for a home sale is a month after the buyer's offer was accepted. If on closing date, the buyer could not come up with the cash, the seller did not lose her house but home prices may have gone down since then. This risk exists because in the modern system of trading, the buyer need not have cash and the seller need not own the securities on trade date, as long the 2 sides can deliver on settlement date. Next, we will learn how it is possible to trade without having cash or securities on trade date. Investor A buys 100 shares at $10 each on trade date. On settlement date, Investor A puts in $400 of her own cash and borrows $600 from a broker. This is similar to buying a house where the borrower makes a down payment and borrows the rest. The price of shares doubles to 20. The investor sells her 100 shares and receives $2,000. The investor repays 600 plus interest to her lender and retains the rest. In this example, the investor was able to trade without having the full cash on trade date. Broker-dealers extend such loans to their institutional clients and increasingly to retail investors. If the share prices go up, borrowing can increase the investor's returns. An investor can sell securities without owning them. This is called a short sale. Investor A sells 100 shares of company B at $10 each on trade date. It does not actually own the shares, so it borrows the shares from a securities lender and delivers to the buyer. We will learn about securities lending later in this lesson. The price of the shares falls to 5. The investor buys back 100 shares for 500 and returns the shares, along with the borrowing fees, to the securities lender. The investor, thus makes a profit, of $500 less the borrowing fees. Short sellers expect share prices to fall. In efficient capital markets, participants should only worry about market risk. A multitude of processes, entities and regulations have evolved to mitigate the other two risks. This makes securities settlement much more complex than paying for goods bought on eBay. Consider a mutual fund manager who wants to buy shares of XYZ Corporation and places an order with a broker. The seller is a pension fund. The buyer and the seller's brokers submit their orders to the exchange and trade is executed. The principal risk is solved through an entity called the custodian. Assume, for a moment, a world of paper share certificates. The buyer maintains both her certificates and cash balances with the custodian. The seller also has a custodian. A custodian is a third-party financial institution. BNY Mellon and State Street Bank are well-known custodians. Assume, for now, that the custodian of the buyer and seller is the same. The principal risk problem is easily solved now. The custodian transfers the share certificate from the seller's vault to the buyer's vault and simultaneously directs funds transfer from the buyer to the seller's bank account. We can extend this logic to book entries. Instead of transferring paper certificates, the custodian does book entries. The simultaneous transfer of cash and securities is called delivery versus payment, or DVP. Securities are delivered in book entry form against payment. A less common mode is free of payment, where securities are delivered without simultaneous payment. But how does DVP happen if the buyer and seller's custodian are not the same? To address the possibility that the custodian of the buyer and the seller are not the same, an entity called the Central Securities Depository or CSD enters the picture as an end custodian. In the world of paper share certificates, the seller's custodian sends the share certificates to the CSD prior to settlement date. The two custodians also maintain cash in bank accounts controlled by the CSD. The CSD transfers ownership of the share certificates and cash simultaneously between the two custodians. Once again, replace paper certificates with bookkeeping entries. Payment is made against the delivery of securities in bookkeeping form by the end custodian. Two separate infrastructures are needed to facilitate securities settlement, even though in many cases, the CSD is providing both. The first is the record-keeping role, which is the CSD role. The second is the securities settlement system that is executing the DVP settlement and consists of the CSD and custodians. The CSD is the ultimate owner of record for securities issued in any country. In the United States, the CSD for equities, bonds and derivatives is the Depositories Trust and Clearing Corporation, or DTCC. The Federal Reserve runs the CSD for government bonds. Some examples of CSDs are listed here. We have covered how principal risk is addressed. We will next learn how replacement cost risk is managed. This risk, as we saw earlier, arises because it is possible to trade on trade date without owning cash or securities. This replacement cost risk is managed by an entity called the clearing house, which comes in the middle as a counterparty to the trade. The original trade is broken into two. The clearing house buys from the seller and sells to the buyer on the same terms the original counterparties agreed to. This eliminates the counterparty risk between the buyer and seller. In return for absorbing this risk, the clearing house charges a fees to participating broker-dealers, who also must post cash collateral with it. This ensures that broker-dealers are not letting their clients take excess risk via borrowing. The buyer and the seller's brokers can focus on getting the best terms, instead of worrying about who they are trading with. If the seller did not deliver securities, the clearing house will buy the securities from the market and settle the trade. If the buyer did not deliver cash, the clearing house will pay. The clearing house becomes the central counterparty, abbreviated as CCP. In the United States, the clearing house for equities is National Securities Clearing Corporation. In markets, where CCPs exist, the substitution of the original counterparty can occur either at the point of trade execution or post-trade. We can now see the distinction between settlement and clearing. While settlement is the payment for delivery, clearing refers to processes that prepare the trade for settlement. For instance, custodians matching buy and sell side of a trade prior to settlement is a clearing activity. The introduction of the CCP is another example of clearing. In securities trading, 3 types of clearing models exist. One is bilateral clearing done directly between buyers and sellers. In central clearing, clearing functions are performed by a third party. Finally, the central clearing house can also become the central counterparty. Which of these models is used is driven by the asset class and geography. Often regulators push for central clearing and CCP to mitigate systemic risks. Let us now complete the trade ecosystem chart with the clearing house included. As you look at this chart, the thing to note is that it is possible for the broker and custodian to be divisions of the same firm. We left off the trade lifecycle at step 4 of trade execution. Next, we will complete the workflow. The custodian receives settlement instructions after trade execution. The buyer and the seller's custodian ensure that they have enough cash and securities held with the CSD prior to settlement. While step 5 and step 6 are occurring, the exchange sends the trade details to the clearing house. In this narrative, step 7 is shown to be sequential to steps 5 and 6 for convenience. In reality, step 7 and step 5 are parallel. Finally, the CSD gets the settlement file from the clearing house and settles the trade. In markets where clearing does not exist, the CSD will settle based on the settlement files received from the custodians, after matching the two. The workflow that we just reviewed results in changes to holdings of 2 financial assets, cash and securities. Assume that before the buyer initiated the trade, she had $5,000 of cash. Her beginning securities position was 0. Meanwhile, the seller's beginning cash position is assumed to be 0. The seller's ownership of 500 shares is recorded in a duplicative way in securities accounts held at the CSD, the custodian and the brokerage firm. At this point, the buyer initiates a buy of 500 shares at $100 a share. The buyer's broker debits the buyer's cash account for $5,000 and deposits the fund with the custodian. The custodian in turn places the funds in a bank account controlled by the CSD. On settlement date, the CSD transfers cash from the buyer's custodian to the seller's custodian. The cash cascades down into the seller's account. The CSD also makes a book entry in the securities accounts held by the custodians with the CSD. One final reflection on trade execution versus settlement. A trade can be executed in many ways, but the output is always an executed trade. From that point, settlements can occur in various ways, but how the trade occurred is mostly irrelevant. We encountered the 3 phases by which ownership of financial assets transfer in the lesson on payments. In payments, it is cash being transferred. In capital markets, typically 2 assets. Cash and securities change hands, but the phases are the same. Our discussion so far centered around buying and selling of securities. There is a separate universe of transactions known as securities financing transactions or SFTs. In this lesson, we will cover only the basics of this vast topic. 2 common examples of SFTs are repo and securities lending. Next, we will learn about them. Consider an institutional investor that owns securities but needs cash. The investor agrees to sell the securities for cash to another entity and repurchase the securities after a specified period. The interest earned by the cash lender is called the repo rate. The securities held by the cash lender for the repo period acts as collateral for the loan made. A similar but distinct transaction is securities lending. Consider an investor who is selling shares it doesn't own. Hence, it delivers the securities on settlement date by borrowing them from a securities lender. To the buyer, whether the seller owned or borrowed the securities is immaterial. The securities lender is exposed to the risk that the borrower will not return the securities. Hence, it asks for collateral, normally cash or safe government securities. On loan termination date, the investor buys the securities from the market, hopefully at a lower price than it sold them earlier at, and returns the securities to the lender along with the borrowing fees. In repos, securities are used as collateral and cash is being borrowed. Securities lending is usually the reverse. While there are more complex variants of repos and securities lending, these examples are sufficient for us to gain a base understanding of the concepts. Let us wrap up this lesson by looking at the anatomy of a trade. The first element is the type of financial asset traded. The second element is the type of transaction. The third is the terms of trade. The fourth is the type of entities involved. The fifth is the modality of trading. The sixth is the geography in which counterparties are located. The specifics of trade lifecycle operations vary with all 6 elements and is outside the scope of this lesson. However, the concepts displayed on this page are the Lego blocks that can be used to create a pictorial model of any scenario. So far, we have learnt how ownership of securities is transferred at settlement. But how is ownership of a financial asset evidenced in the first place? To answer this question, we need to learn 2 concepts: bearer versus registered forms and paper versus bookkeeping form. Let us look at each one. The bearer form means that ownership of the asset is evidenced by the possession of a physical or digital artifact. An example is a cashier's check, which is payable to the bearer of the check. A digital equivalent is a virtual prepaid card. The registered form means that ownership is evidenced by inclusion of the owner's name in a register that is recognized to be the source of truth. An example is a motor vehicle title. If someone stole the title document, she would not own the car until a public agency recorded the change of ownership in its database. Historically, some securities like bonds were in bearer form, but now most securities are registered. Ownership can be evidenced by physical paper or in bookkeeping form. Historically, at the time of paper share certificates, the physical paper would be endorsed in the name of the buyer at the time of a sale. However, ownership of securities is now mostly tracked in bookkeeping or dematerialized form. We can now organize assets into 4 quadrants based on how their ownership is evidenced. In the equities example we just covered, ownership is registered with the central securities depository in bookkeeping form. But it would be difficult for a central utility to track millions of shareholders. When an investor buys shares of a company, the central securities depository is the registered owner on the books of the company and the investor is the beneficial owner. This is called the indirect holding system. The investor, which could be an individual, an operating business or a fund legal entity, is the beneficial owner. The broker-dealer and custodian bank tracks ownership at the level of beneficial owner. The CSD records ownership in the name of the CSD participant, also called the street name. CSD participants are typically broker-dealers and custodians, who hold accounts with the CSD on behalf of their clients. Finally, the issuer, which is the company that issued the securities, tracks ownership at the CSD level. While paying dividends, the issuer simply deposits the total amount with the CSDs, from where it is allocated to beneficial owners. The largest shareholder in any company in the U.S. is usually DTCC, the U.S. CSD. There is some additional nuance here that we'll cover in the next lesson. Going beyond securities, let us identify the various models of record keepers. First, there may not be a designated record keeper, for instance, in Bitcoin. Even when we buy Bitcoin through a brokerage firm, that firm doesn't own the Bitcoin ownership ledger. Next, we can have a decentralized model with trusted third parties acting as record keepers. Our bank is the trusted record keeper for deposit account balances. Next, records of end owners could be tracked with a central record keeper. Some countries like Spain have a direct holding system where the CSD tracks end owners of securities. Finally, we can have an indirect holding system with a central record keeper. This is common for securities in Western countries. Now we will summarize the 4 types of entities involved in capital market operations. The first group are the principals who are buying or selling. The second group are agents who are acting on behalf of principals. The third group are industry utilities that facilitate the smooth functioning of capital markets and don't represent any one side. Finally, there are entities who represent issuers that issue securities, whether governments or corporations. We will discuss issuers' agents in the next lesson. Now, we will recap the first 3. The principals could be individuals. They could also be legal entities like funds that pool funds of investors. Finally, they could be investing arm of operating entities. This includes corporations, governments, sovereign wealth funds, pension funds, insurance companies, banks and not-for-profits. The agents represent either the buyer or the seller. Professional money managers take decisions on where to invest. Broker-dealers execute trades. Custodians facilitate settlement. These roles can be performed by divisions of the same company. We will learn more about them in the next lesson. The market infrastructures that we discussed include exchanges, digital trading platforms, CSDs and clearing houses. We are at the end of this lesson and we are now ready to learn about asset management products. But before that, review the summing up section. I will see you on the other side.